think a new bull market really did start in early April. The ISM is still below 50. I think that's consistent with the early cycle. We still have a huge housing deficit. And until we start building more homes, I think that's a leg to growth next year. FINRA margin debt has shown three consecutive months of declines. That's not consistent with the top. We know sentiment's still on average pretty bearish, and it's one of the most hated rallies. And to understand that, consider that there's still a lot of stock buybacks taking place. This is from Goldman Sachs. And yet, if you look at positioning of systematic macro, according to Goldman, they're only flat right now. Now they're flat while the market's rallied 20%. That's pretty surprising. And if you look at when they go above zero, of course, those are boom times for stocks.
Tom Lee believes a new bull market began in early April, despite widespread skepticism. He points to falling margin debt, continued stock buybacks, and underexposed macro funds as early cycle signals. While many investors remain cautious, retail traders bought the dip during April's sharp drop and were proven right as the market quickly rebounded. Lee argues that the U.S. economy is stronger than most think, with resilient companies that have weathered major shocks over the past few years. With deregulation, tax cuts, and Fed easing likely in 2026, he sees room for continued growth. He also highlights Bitcoin's long-term potential, driven by liquidity, scarcity, and adoption trends. Trying to time the market, Lee warns, often leads to missed gains. The best market days make up the bulk of annual returns, and sitting out could be costly. For those looking ahead, he suggests focusing on washed-out stocks, small caps, and industrials, areas likely to benefit from the next economic upswing.
April 2nd was a Black Swan event, and it's not the Black Swan movie premiere, but it was an improbable event, as Nassim Taleb talked about. And a Black Swan means something that is not expected to happen, but it has happened. And we know it was a Black Swan event because Nassim Taleb's Universa fund generated 100% return that month. His fund only makes money on Black Swan events, and the last time it made money was COVID. So this was indeed a Black Swan event. And because of that, the S&P went from 6,147 and collapsed because we had the drug tariffs in February, and then we had the DeepSeek event, and of course, Tariff Liberation Day. That triggered a huge amount of panic. And as you can see, we fell 20% in like 2 weeks. But instead of the market crashing, we had advised our clients that waterfall declines, 17 out of the last 18 waterfall declines were V-shaped. A waterfall decline in the stock market is not new information to you. It's a panic. When markets panic, just keep this in mind. It's usually a V-shaped bounce. And we argued it would be V-shaped. And in fact, it has been V-shaped, contrary to what most people have said. Now, this is where I'd like you guys to make a personal assessment, because you aren't alone. A lot of people, when the market was falling, hedge funds, long-only managers, they went to cash. I've done so many Zooms in the past 2 weeks about fund managers that have probably 50% of the exposure they want to cyclical stocks, or even 0%. So they are panicked and they're hoping for a pullback so that they can re-risk. So here's 5 reasons why I think investors are still off sides, and that's why you've noticed that the stock market kind of has a bid every day, because people are still off sides. So let me explain. The first is, a lot of people said there was going to be a recession. And in fact, JP Morgan was one of the first. They said they raised the odds of a recession to 60%. But here's the thing. If you want to know who's the best at predicting a recession, I would say the single best economist is the high yield market. And this is the high yield market. And as you can see, it did soar. This is the spread to treasuries, to 460 basis points wide. But that's not a recession panic. The high yield market is not manipulated by the Fed or the Treasury, so it's pure signal. If you go back the last 15 years, 460 basis points wide on high yield is nothing, because during COVID it got to 1,000. That's a recession level. During the Fed's fastest rate cycle in history, it got to 600. That's not a recession signal. At that time, if many of you were our clients, we told you that's not a recession signal. It has to get to 800 or 1,000. And we were just at 460. So the high yield market said there's no recession. And then, as you know, recently JP Morgan basically dropped their recession call. So economists have predicted like 18 of the last 2 recessions. The supply chain is taking a hit. And then a lot of people are saying they're shorting stocks because of that, okay? And you might think that. You're going to say, Tom, the container ships from China, it's down 50%. So they're going to say, okay, it goes from the container ships to the trucking, to the warehouses, to the retail stores, and pretty soon everything's going to crash. But that's not how it's going to work. First of all, as you can see, as soon as the tariff wars de-escalated, container ship bookings jumped 50%. So it now looks like this. The stock market looks through that. That happens at government shutdowns. It doesn't really cripple the economy. Yet hedge funds were shorting cyclicals this entire time. So again, your people are looking at yesterday's newspaper and trading on it. The third is the VIX surged, but when the VIX surges, it forces everybody to liquidate. Okay, so the top chart here is the VIX. And the bottom is speculative longs on futures. Every time the VIX spikes, funds are forced to de-risk. Okay, but look what happens after the VIX goes down. They're forced to add risk. So here's the thing. In the midst of the VIX 60, our FSI clients got this message. You buy stocks when the VIX is over 50, and it's confirmed when the VIX is less than 30. Just remember that. The next time the VIX explodes to 60, it's a gift because you know everyone's being forced to sell. And the bottom in the stock market, we highlighted this, there's not been a single bottom that wasn't confirmed once the VIX falls below 30. So if you look back, that VIX 30 was like mid-April. The fourth is, many people say the U.S. is the end of U.S. exceptionalism, like they want to buy Europe. I just had a call with this client, he's so bullish on Germany, and I pointed out to him that German tech stocks are now 50% more expensive than US tech stocks. Europe is not cheap, and they don't have great companies. In fact, if you look at the 25 biggest companies in the world, it's kind of hard to see the ticker, only 4 of them are not American. I don't see how tariffs, a Fed being slow, people not liking Trump, I don't think how that's going to create 24 great non-US companies. All the best companies are in America. And then retail bought the dip. So if you are one of the few who bought the dip in April, congratulations, because you called it right and you nailed it. And we know retail buying was record during the sell-off. And I can't tell you how many institutions told us that they were shorting that because they want to short retail. They're dead wrong. Retail investors got this right. And yet, now what's happening? Hedge funds are frantically covering their shorts. It's going to take them a long time to cover their shorts. So now I want to look at 2026. So it's explaining where things are, and I will say, so if you are bearish still, I would urge you to think about 2026, okay? I think stocks are in better shape today than they were in February of this year. So when the market was at its old highs, I think it's actually a better risk reward now. First, we have visibility on the tariffs. So the tariff, if you didn't know what was going to happen in February, now you know what's going on with the tariffs. The second is you have to start looking at 2026. We're in the middle of 2025. The stock market always looks 6 to 12 months ahead. So you want to think about 2026 right now. And next year, we have tax cuts. We have a lot of deregulation in the pipeline. And we have more Fed cuts in 2026. Like the Fed's not cutting now, but they're going to cut next year. And companies are benefiting from freer trade. These tariff deals are allowing U.S. companies to have better access to other markets. That's big upside. So if you ask me, I think there's a lot of earnings upside for next year.
Tom Lee believes a new bull market began in April, despite ongoing bearish sentiment and recession fears. He points to key early cycle signals like falling margin debt, stock buybacks, and cautious institutional positioning. Retail investors bought the dip while many funds stayed on the sidelines, missing a sharp V-shaped rebound. Lee argues U.S. companies have proven resilient through major shocks and sees more upside ahead, with 2026 bringing tax cuts, deregulation, and possible Fed easing. He warns against market timing, noting that missing just a few strong days each year can erase most gains.
And a second thing to keep in mind is that companies are battle tested now. This is what you have to remember. We're living through history because COVID happened in 2020. And I've been in markets for 35 years. COVID was the most improbable thing. You had to go back to 1918 to find a precedent, and there wasn't anybody alive. No portfolio manager was managing money in 1918 unless they were a time traveler. But companies survived that. Then companies survived the bullwhip supply chain effect in 2021. They didn't go bankrupt. They didn't go bankrupt in 2020. They didn't go bankrupt in 2021. Then we had the biggest inflation surge since the 70s. No company went bankrupt. And then Fed did the fastest rate cycle in history. Earnings grew. I mean, think about that. Like, we've taken the S&P through 4 huge tests at them, and they kept growing earnings. By the way, did you look at European cyclical earnings during that time? They've been terrible. Asian EM stock earnings were horrible during this 4 years. The only region that was growing earnings during that period of time was the US. And now we just threw the tariff gauntlet at them. And if you look through first quarter earnings, 79% of companies beat by an average of 8%. I mean, it's been a pretty good quarter. So I think companies survived the latest black swan, and yet investors are shockingly cautious still. And like, for instance, if I could see a show of hands, before I spoke, could you raise your hands if you are cautious or bearish right now? Okay. And then how many of you are bullish now? All right. You're the smart ones. And I think it's really because I think PEs should be going up. So like, there's people who are telling you, oh, U.S. exceptionalism over, the PE should be contracting. I think the multiple of the market should be increasing from here. And don't forget, everyone told you there was not a Trump put. There is a White House put on the stock market. And remember, everyone's going to tell you there's no Fed put. There is a Fed put. You have a Fed put and a Trump put, which is why I think there isn't the same downside on stocks that people expect. However, in the near term, market could be overbought. Mark Newton's going to talk about that more tactically later today. I'm just giving you my thoughts about the next 6 to 12 months. And in terms of what we want to own, this is how we would be playing a stronger 2026, okay? You want to buy washed out stocks. This is something Walter Deemer references. It's a stock that's so sold out that there's no one left to sell it. And among that is the Mag 7 and Bitcoin. I think they both peaked early. They both bottomed before the S&P bottomed. And a lot of the Mag 7, as you know, got really washed out. Look at Tesla, for instance. We like small caps because they're benefiting from deregulation and an easing Fed, which is happening next year. And of course, that means you'll have a better merger environment next year. We like industrials because of all the onshoring and potentially expensing, 100% tax expensing of your CapEx. And we like the financials because, if the U.S. is not in a recession, then financials lead us out. And by the way, I think a new bull market did start on April 7th because we had a 20% drawdown. So the bull market post-COVID ended with 2022, and then there was a bear market, and then the 2022 bull market started in October. It ended February 18th, and we're in a new bull market. So this, just think of it as sentiment has completely reset. If you're receiving our research, we talk about the AAII sentiment has gotten so bearish, it's associated with the bear market. So we've already reset expectations to what you expect to see at the start of a bull market. And we have a list of washed out stocks if you're trying to do this individual names. Like Coinbase. Well, see, these stocks have already moved, but we had identified these a few weeks ago. Coinbase, Tesla, Robinhood, Supermicro, MicroStrategy. But you know what? Each one of these is moving on their own time. So I don't think it's too late to buy any of these. And these are the SMID cap washed out stocks as well. And they have a similar profile that we've been identifying. This black swan of 2025 is a reminder, try not to time the market with most of your money, okay? And here's the math I want to give you. Since 1928, the S&P returned 8% a year. But if you missed the 10 best days of every year since 1928, your return is negative 13%. Those 10 best days are 2,000 basis points a year. So 20 percentage points of the gains in any year come from 10 days. And then since 2015, okay, for the last 10 years, S&P returned 12% a year. But if you didn't own the stock market in the 10 best days, and like this year we had most of those 10 best days happened since April 7th, your return's minus 10% a year. You literally lose money if you try to time the market. Unless you're a really good market timer like Mark Newton. So that's 2,200 basis points a year. And I'll just give you an example. Like in 2023, the S&P was up 24%. But if you missed the 10 best days, you were only up 4%. And last year, the market was up 23%. But if you missed the 10 best days, you only were up 4%. So don't time the market. Bitcoin has 3 or 4 things it really follows, okay? It follows network effects. So the number of wallets and the activity per wallet still explains 87% of the price change in Bitcoin. Bitcoin still follows global liquidity, which I am shocked at, but there's a 10-week lead time. So if central banks ease, Bitcoin follows by 10 weeks. And the third is the halving, which is when the block reward gets cut in half. I don't think it's following the halving cycle as closely yet, but we'll find out. Actually, the next 3 months will determine if it's true or not. But look, if Bitcoin at 100,000, it's still early days.
Tom Lee believes a new bull market began in April, despite ongoing investor skepticism. He points to falling margin debt, strong retail buying, and resilient corporate earnings as signs of early cycle strength. Major institutions missed the rally, while retail investors bought the dip and were proven right. Looking to 2026, Lee is bullish due to expected tax cuts, deregulation, and Fed rate reductions. He warns against market timing, emphasizing that missing just a few strong days each year can wipe out gains. Bitcoin and equities both show long-term potential for those who stay invested. Do you think the bull market is already here? Are you positioning for 2026 or waiting it out? Share your thoughts below.